How to extract funds from your limited company when you close it. When closing a limited company, the key objective is simple: extract the remaining funds in the most tax-efficient way. One of the most valuable opportunities available to directors is the £30,000 tax-free redundancy payment, but this should be considered alongside other extraction strategies to achieve the best overall outcome. Choosing the right strategy. The optimal approach depends on the level of funds remaining after settling all liabilities, whether you have been paid as an employee under PAAR, your wider personal tax position. The method of closure, strike-off, or members' voluntary liquidation, MVL, a structured plan is essential to avoid unnecessary tax and HMRC challenges. The £30,000 tax-free redundancy opportunity. For many directors, redundancy provides the most tax-efficient starting point. If you qualify as both a director and employee, you may be entitled to a genuine redundancy payment when the company ceases trading. Key points. Up to £30,000 can be paid completely tax-free. Applies to statutory and contractual redundancy combined. Any excess above £30,000 is taxed as income. To qualify, you must have a genuine employment contract. You must have been paid via PAYE, not just dividends. The redundancy must be legitimate. Company closure qualifies. Proper procedures and documentation must be followed. HMRC will challenge arrangements that are not commercially justifiable, so compliance and documentation are critical. Other tax-efficient extraction methods. Capital distribution via MVL. Where retained funds exceed £25,000, a member's voluntary liquidation allows distributions to be treated as capital. This can qualify for business asset disposal relief, reducing the tax rate to 10% on qualifying gains, significantly lower than income tax rates. Final dividend payments. Dividends can be paid from retained profits prior to closure. While generally more tax efficient than salary, they are still subject to dividend tax rates and allowances. Director's loan repayment. Any loans you have made to the company can be repaid tax-free. However, if a loan is written off instead, it becomes taxable income. Final salary or bonus. A final salary or bonus can be paid, but this is subject to income tax and national insurance. This approach is typically used where personal allowances or pension planning opportunities exist. Closure process key steps. Choose the appropriate closure route, MVL or strike-off. Settle all liabilities, including tax, corporation tax, VAT, PAYE. Implement redundancy procedures where applicable. Extract remaining funds using a structured, tax-efficient plan. Complete formal closure via liquidation or strike-off. File final accounts and notify HMRC and Companies House. Common pitfalls. Poorly documented redundancy claims. Extracting funds before settling liabilities. Using strike-off where an MVL is more appropriate. Missing final tax filings and deadlines. Failing to formally notify HMRC of cessation. These errors can lead to penalties or increased tax exposure. Professional input matters. Each situation is different, and the timing and combination of extraction methods can significantly affect the overall tax position. A structured approach allows you to maximize the £30,000 tax-free redundancy opportunity, utilize capital treatment where appropriate, ensure full compliance with HMRC requirements, minimize overall tax liabilities. Practical strategy. In most cases, start with redundancy if eligible. Use MVL for larger balances to access 10% capital gains tax rates. Use dividends or salary selectively where appropriate. Final thought. Closing a company is not just an administrative exercise, it is a tax planning opportunity. Handled correctly, it can result in substantial tax savings. Handled poorly, it can trigger unnecessary tax and compliance risks.